I am thrilled to introduce Dr. Mark Zandi, one of our own board members and the chief economist at Moody's Analytics. I know Mark many years. We published together job numbers almost 10 years. Mark, of course, is not a respected leader in economic analysis, but at this moment, he is really in high demand now in DC. So I really thank him for being here. And thank you all for being here all together. Thank you.
Thank you, Ahu. It's really good to be here. Yeah, Ahu and I go way back when she managed research at ADP, the payroll processor. Oh, thank you. And she hired us to take ADP's data and use that to create an estimate of the Bureau of Labor Statistics employment number every month. You know, the big payroll number, in Wall Street, that's like the key statistic. We're all focused on that first Friday of every month where that number comes out. You know, what's job growth going to be? And our job was to take the ADP data and marry it with other information and produce a forecast of what that would be. I'll have to tell you, nothing in my professional career has made me more nervous than that Friday of every month predicting that damn BLS number. It was an impossible task. If you just think about that for 3 seconds, you go, that's not going to happen. You're not going to do it. Because the BLS number is based on a sample. The ADP is based on the ADP record, which is, you know, some subset of what's going on. And, you know, there's so much randomness in the data. You know this better than I in the data that we look at. To nail that number is like, I think it's impossible. You can't do it. But we tried. So literally Friday, the first Friday of every month, I'd wake up and I'd just be nervous the whole time until the damn number came up. I feel liberated when I lost that contract. I was so happy. Yeah. Liberated. But Ahu and I go way back, and I just want to say, you've got a gem in Ahu. She's everything you want in a leader of an organization like Coleridge. And I'm just honored and privileged to be part of the board. I'm a little surprised that you asked me to speak, though. An economist? Are you sure? And I noticed there's no clock here, which is like, wow, that's really dangerous. That is dangerous. I can speak for 3 days, no problem. So I'm going to take out my cell phone. Where is my cell phone? Right here, and just make sure that I don't go over. Well, my task is to give you a sense of the economic outlook, and I'm going to make 3 points and show a few slides. Point number one, I think the obvious, the economic outlook is incredibly uncertain. I've been a professional economist. I was just doing the arithmetic last night. 35 years, I've been doing this for 35 years as a professional economist. Started my own company back in 1990 and sold it to the Moody's Corporation 15 years later, and I've been with Moody's ever since. And there's only 3 other times in that 35-year period where I've been as uncertain about the economic outlook as I am today. And no surprise, 9/11, pretty uncertain. Global financial crisis, really uncertain. Pandemic, no idea. And here we are in this environment. I'm equally as uncertain about where we're headed. And that goes to the obvious fact that economic policy is uncertain. It's going to be determined by the president, what he does or what he doesn't do on lots of different fronts. And to gauge that is incredibly difficult, near impossible. And you can see that in the first slide I want to show. This is an index that Baker, Bloom, and Davis put together, Economic Policy Uncertainty Index. This is daily data going all the way back to the mid-1980s. It's based on a few things. One of the most important is that they look at the media and look for citations for key words, economic uncertainty, policy uncertainty, as a measure of that degree of uncertainty that's out there, and they scour the media for these keywords. And you've heard the word uncertainty a lot, I assume. I certainly have, and you can see that in the index. The index is equal to, roughly speaking, 100 in the 25-year period between 1985 and 2010, so just right after the financial crisis. You can see the all-time high was during the teeth of the pandemic shutdowns back in March, April of 2020. And you can see the current period, we're getting there here pretty quickly. A couple of other measures are in here. They look at tax policy, how much of the outstanding tax policy has not been nailed down. It's temporary. So for example, in the current environment, the Tax Cut and Jobs Act, individual tax cuts, they will expire at the end of this year unless Congress passes a piece of legislation to extend them. That adds to the uncertainty. And then also looking at professional economists like me, there's a survey that's done by the Federal Reserve of Philadelphia every month of different forecasts, and they look at the dispersion in the forecasts around that. I will say, though, that one I don't get quite as much, because when there's what I find as a professional economist is when there's a lot of uncertainty, everyone kind of drives to the consensus. There's actually less dispersion in people's thinking because they don't know. They just kind of try to hide behind the consensus, and you see a kind of a convergence. But nonetheless, they include that in their index. So I'd say the economic outlook is about as uncertain as it's been, really, except for a few other times in my professional career. Just incredibly uncertain period. The second point I'd like to make, and I should say, this is not to be dismissed. Even if everything goes smoothly with the economic policy changes, the fact that there is uncertainty has economic consequence, right? I mean, your instinct when you're uncertain is to freeze, and that's what we're seeing, or you can sense it. We don't have a whole lot of hard data yet to know for sure exactly what's going on and what the impacts will be, but it's increasingly clear that businesses are starting to sit on their hands. In addition to an economist, I'm a business person. I have a couple hundred economists that are in my world around the globe, and we have a business. We provide economic forecasts and analysis and data to a broad array of institutions and governments around the world for lots of different purposes. Capital planning, accounting, budgeting. When we think about it, the economic forecasts go in lots of different places. As a business person, very simply, when I make a decision to whether to invest or not, I open up a spreadsheet and I put in the cells my expected revenue over time, over the next year, over the next 5 years, over the next 10 years, depending on the horizon of the investment. I make an estimate of the costs of doing that investment. How much does it cost to do it? I take the difference between the two things, revenue and expenses, and that's my profit. I calculate the present value of that stream of future profits. I compare it to my cost of capital. How much does it cost me in terms of, if I have to borrow debt or equity. If the return on the investment is greater than the cost of capital, accounting for the uncertainty, I'll make the investment. But to get to that bottom line, I have to fill in every cell in the spreadsheet. If I can't fill in the cells in the spreadsheet, I can't calculate my return. If I can't calculate my return, it's not like I'm going to go cut. At least that's not my first instinct. I'm not going to go cut people or cut back on what I do. But it does mean I'm not going to do it. I'm just not going to do it. And I suspect business people around the world are opening up that spreadsheet, and given the tariffs, the on-again, off-again tariffs, as just an example of the uncertainty, can't calculate your return. You can't calculate your return. You're not going to make that investment. You can also see it in the Federal Reserve. The Federal Reserve Board, I don't know how closely you follow what the Fed's doing. They were cutting interest rates late last year. They stopped cutting rates at the start of this year. And point blank, if you go look at the minutes of the FOMC meetings, that's the committee that decides interest rate policy, and you take a look, they say, we're not going to change policy. We're not going to continue to cut interest rates until we have clarity around economic policy. And it makes sense. I mean, take the tariffs again. Think about that from the context of setting interest rates. What do I do with that, right? Because the tariffs slow growth. They weaken economic growth. So if you look at that and you're at the Fed, you say, oh, I should cut interest rates, right? Because I want to support the economy in the context of the tariffs. But the tariffs also raise prices. The way it works is it's just a tax on consumers. Prices rise, that adds to inflation. And at times like this, when inflation expectations are pretty fragile, there's a concern that that price increase will get embedded in those expectations, which will affect wage demands, and you can kind of get into a kind of self-reinforcing dynamic that you don't want. So that would argue for higher interest rates. So what do? Do I cut interest rates because of the weakening in growth that I anticipate? Or do I raise interest rates because of the higher inflation? The answer is I don't know. This goes to policy uncertainty, and you sit on your hands. And so the Federal Reserve is now sitting on its hands. It's not going to cut interest rates until it has clarity around, at least some clarity around economic policy. So uncertainty matters, even if the president ends up doing exactly the thing that will lead to the best economic outcome. Doesn't matter. Just the ups and downs and all arounds and the swings and listening to every word. And the stock market is listening to every word. I don't know if you noticed, but I watch the stock market in an unhealthy amount of during the day. And my mood goes up or down whether I see red or green on the screen, like many Americans. And the reds and the greens are very closely correlated with what the president is saying at that given moment. And he's saying a lot all the time. So you see these swings up and down. So policy uncertainty is important. It matters. It's a factor that we should consider in the case of economic outlook. So point number one, I said I was going to make 3 points. Point number one is the economic outlook is highly uncertain, but that won't stop me from giving you my outlook. I do that for a living. I have to put pen to paper, so to speak. And point number two is I think recession risks are high and rising, but odds remain that we'll be able to navigate through without an outright economic downturn. Just to give you a number to make that concrete, and here I don't want to imply too high level of precision, but this is just to give you a sense of things. I would put the probability of a recession beginning at some point in the coming year at as high as one third. So good news, less than 50-50. Bad news is that's pretty elevated and moving in the wrong direction. Just for context, in a typical economic environment, the probability of recession would be about 15%, the so-called unconditional probability of recession. That just looks at history and you say, okay, historically, in recent decades, you get a recession every 6 or 7 years, so you do the arithmetic, it's about 15%. So, very, very elevated. By the way, just as a sidebar, because I'll do a little advertisement, because I am a business person and I want to sell you something. I do have a podcast. I don't know if you've listened. It's called Inside Economics. Have you heard of Inside Economics? It's a weekly podcast. You have to be a little nerdy to enjoy the podcast, but I sense you all qualify, for this. You would enjoy this, and we talk about all these things that I'm talking about now and the probability of recession. I've a couple co-hosts and we have guests that come on regularly. So I highly recommend that, but 1/3 probability of recession. The reason why recession risks are so high does go back to economic policy. And front and center, the thing that is most, and I've already alluded to this already a few times, the thing that makes me most nervous most immediately is the tariffs, the mounting global trade war. And you can kind of get a sense of here the uncertainty and also the implications of different tariff regimes that may be implemented here over the course of the next few weeks. Actually, the next few days. I think April 2nd seems to be kind of a big day, although the president seems to be buying that back, as we speak. But this shows the effective tariff rate back to 1900. So I'm giving you a lot of history. The effective tariff rate is simply you just total up all the tariff revenue that the government collects, divide by the value of the imports that are subject to the tariff. And you can see if you go back before President Trump's first term, we were pretty close to zero. I think the effective tariff rate was about 1% on the nose, down considerably from where we were historically. The other point I want to point in history I want to call out is 1930. So look at 1920, look at 1940, go halfway between, that's 1930. That's the Smoot-Hawley Act. The Smoot-Hawley Act was passed in 1930. That was broad-based tariffs and is well considered to be, a significant contributor to the Great Depression of the 1930s. Anyone see Ferris Bueller's Day Off? You remember that scene, the Smoot-Hawley Act? But by the way, that's one of my top 10 movies, top 5 maybe, top 5 movies. Fantastic movie. If you have young people who haven't seen that, I don't know how well that holds up though. Has anyone seen that recently? It holds up pretty well. Yeah. Matthew Broderick. It's a really good movie. Ben Stein was the econ professor, at the time. He comes from a great lineage of economists. His dad was a great economist, and really good movie. President Trump in his first term raised tariffs, so the effective tariff rate at the end of his first term was 3%, still pretty low. If you total up all the tariffs that have already been implemented in President Trump's second term, that would include tariffs on Canadian imports, on Mexican imports, on imports from China. That would include tariffs on steel and aluminum. That's where we are now. The effective tariff rate as of today is about 7%. If he goes through, totally through with everything that he's said on universal tariffs, that would be kind of the 10% universal, 20% on China. That's the increase on tariffs on China. Going into this, the tariff rate was 10%. He's added 20 percentage points to that, so we're now at 30. You can see that the effective tariff rate is, very close to double digits, and you can see, depending on what he does here, the tariff rates will go up to a significant degree. If you put 100 economists in a room and ask them what you think about tariffs, are they a good policy? Broad-based tariffs, not strategic tariffs, not tariffs on a product or trying to make a point with regard to trade policy, but broad-based tariffs. You ask economists, what do you think of tariff policy? I assure you 99 of them will tell you it's a bad idea. It's a bad idea. There's one who will say it's a good idea. I don't know who that is, but 99 will say it's a bad idea. The reason is because it's a tax. It's a tax on consumers, American consumers, you and I as consumers. The evidence from the tariffs imposed in President Trump's first term is that the bulk of the tariff increases are passed through to consumers in the form of higher prices. Now, some of it is shouldered by retailers and distributors. Some of it is shouldered by foreign producers who are facing the import duty. But the bulk of the tariff increases goes on consumers. And it's a very regressive tax, because lower middle-income households spend a much higher share of their budget on tariffs than do folks in the top part of the income distribution who spend their money on lots of different things. So it's a tax on consumers. That's through the form of higher prices. That's a negative for the economy. Also, if history is any guide, in the recent period is consistent with this, other countries aren't going to stand still. They're going to respond, so-called retaliation. Some will retaliate in kind. The Chinese will respond tit for tat with regard to whatever we impose. They're going to impose something that's comparable to that or consistent with that. Some countries not so so much, they feel like they're not in as good a negotiating position. Maybe Mexico would be a case in point. Some other European countries will be a case in point. But other countries are pretty upset. You can see what's going on in Canada. Very likely, and given the political situation there, likely they're going to respond in kind. So and that costs American jobs, right? So if foreign countries are retaliating, imposing their own duties on American product coming into their country, or doing other things, imposing other trade barriers, that costs American jobs. And in fact, if you go back to President Trump's first term in that tariff war that ensued back in 2018 and 2019, by 2019, in the year prior to the pandemic, the U.S. manufacturing industry was in recession. It was contracting. Industrial production was falling. That's output. Employment was declining. The farmers, the agricultural sector was getting crushed. You may not recall, but President Trump cut checks to the farmers to compensate for the loss of sales to China of U.S. agricultural products. China is a massive market for U.S. farmers, and that got cut off, and he had to cut checks. So it costs jobs. So the effects of the tariffs are higher prices. It's a tax. It's fewer jobs. There's also a thought or an argument that maybe the tariffs will incent global businesses to expand their operations here in the United States. So, it makes it more attractive to produce in the United States. That'll create jobs. But that's not going to happen. That makes no sense whatsoever. Going back to the capricious nature of the tariffs. The tariffs are put in place under executive order, not in legislation. And because they're under executive order, they can be undone by a stroke of a pen or by a ruling by a court who decides that the tariffs are illegal, and there's a potential for that possibility down the road. So if you're the CEO of any major global corporation on the planet, and you're looking at the U.S. as a place to invest in, and you don't know what the tariffs are going to be tomorrow, next year, or certainly not 10 years from now, that's a pretty significant headwind to you deciding to locate your operations in the U.S. So, I look at this and I say, what the heck, this is not going to work. It's just not. And by the way, I will say, I did ask OpenAI, what they thought of tariffs. And I was a little bit surprised by it. I got into a bit of an argument with her because she said to me, well, there's mixed views on this. No, there's not. No, there's not. There's no mixed views on this. Give me your sources. There are no sources. There's no sources on the other side of this. This is a really bad idea, and it's going to mean weaker economic growth. And if it's carried to the end, if the president actually follows through on the things that he suggests he's going to follow through on, and maintains these tariffs, the probability of recession isn't 35%. We're going into recession. But the mere fact of that suggests to me that he's not going to follow through, just like what happened under his first term. Once it becomes clear that the tariffs are doing damage, stock market's going to go down, that he will respond to that and pivot, very good at pivoting, and declare victory and move on. Now, that's a pretty, think about that, what I just said. That's my economic outlook. That's so tenuous, right? I mean, incredibly tenuous, and thus, back to my first point, the uncertainty here, the uncertainty around my economic outlook has rarely ever been higher, because it is hinged on us trying to figure out what's the motivations for the policy and how it's going to be implemented or not. By the way, as you can tell, I could talk about this for 3 days, but I'm not going to do it, because I do need to call this to an end in a few minutes, and I have a third point. But there's a lot of other policies out there, too, that are doing the same thing, the same kind of stuff. The DOGE cuts to government jobs, the DOGE cuts to government funding. We haven't talked, and I won't talk about because I don't have time to talk about immigration policy. And, don't get me wrong, there's things in all this that I think is useful. I'm all for a more efficient government and rooting out fraud. I'm all for securing the southern border, But the way these things are being implemented in the uncertainty and angst that it's creating is highly counterproductive. And I haven't even begun we haven't even talked about, I haven't even uttered the words tax and spending policy, right? There's this massive reconciliation bill that's trying to snake its way through Congress. The Congress does need to do something about taxes, otherwise tax rates are going to go up on everyone. And that costs money, a lot of money, trillions of dollars worth of money. And how are you going to pay for that if you are going to pay for it? And if you're not going to pay for it, what does that mean for the fiscal situation, which is also very tenuous? Our budget deficits are very high. Our interest payments are rising very rapidly. That's not a good thing. We need to address it. But how are we going to do that in the context? And then, by the way, what about that Treasury debt limit? Do you remember the Treasury debt limit, that battle? We've got this arcane law that says the Treasury can't issue debt above a certain amount. Every few years, we bump up against that debt limit. It's either suspended or extended, we go on to the next Treasury debt limit battle. But we're going to be in the middle of that in the not too distant future, in the next few weeks, couple of months, because the debt limit was extended to the start of this year. The debt limit clock started, and the U.S. Treasury is going to run out of cash to pay all its bills come late July, early August. It's unclear exactly when, because that depends on receipts, tax receipts and government spending. By the way, just a sidebar, just reminded me, the IRS is facing significant DOGE cuts. I don't know if you caught a Washington Post article saying that people are not paying their taxes because of a lack of compliance. And the lack of compliance is related to the fact that no one's looking over their shoulder. And it could cost not tens of billions of dollars in revenue each year, it could cost hundreds of billions of dollars in revenue each year. So if that's the case, if people aren't paying their taxes, that X date when the Treasury is going to run out of cash isn't going to be late July, early August. It's going to be earlier than that. But something's got to be done around that. That also adds to the drama that is going to unfold here. So it's not just about tariffs. There's a lot of economic policy balls in the air. I'm assuming that nobody wants to push the economy into recession. Therefore, policy will shift when it's necessary to avoid that economic downturn. But I say that with no confidence. No confidence. No confidence. Okay, let me get to my final point number 3, and that is, I did want to make one other point before I move on to point number 3. Cool. This is I wanted to give you one indicator to watch to gauge whether we're going down the recession path or not, because I am so uncertain. And that is consumer confidence. Most times consumer confidence reflects the economy. It reflects unemployment. It reflects the ability to find a job. It reflects inflation. It reflects the price of a gallon of regular unleaded. It reflects stock prices. But there are times when the causality shifts, when consumers get nervous, they lose faith, they stop spending, and you go into recession. And that's the point of this chart. This shows one of the best measures of consumer confidence done monthly by the Conference Board. Again, I have data all the way back to 1980. You can see the recessions. Those are the shaded bars in the chart. And the one regularity that you see is that just prior to recession, consumers lose faith. That measure of consumer confidence falls very rapidly. And a good rule of thumb is that if that Conference Board measure of consumer confidence falls by more than 20 points in a 3-month period, consumers are running for the bunker. They're going to stop spending. They're losing faith. We're going into recession. I did this chart for the folks at Coleridge, Nick, last week. We got a data point yesterday. You can do the visual arithmetic. 92.9. Just think about, look at that chart, 92.9. That is down 17 points in a 3-month period. So not quite consistent with that rule of thumb, but very consistent with a lot of yellow flares going off here. We need to watch this, very, very, very carefully. I bring this up also in the context of my third point, and that is that at this point in time, when the economy is as uncertain, when the economic outlook is as uncertain that it is, and the economic outlook as uncertain, data is critical to understanding what's going on. And series like these, series we get from the government, are really important to get a sense of what's going on and how we should respond. And the quality of the data that we're getting is increasingly suspect. It's increasingly difficult. We're more and more reliant on data, but yet the quality of our data is eroding. And you can see it in the consumer confidence measures. I'm showing you the Conference Board survey. There's another good survey, and I apologize for anyone who's graduated from the University of Michigan. I just make that point up front. There is another survey done by the University of Michigan, also a long-standing, a venerable survey, but it's all screwed up. It's all screwed up. And that's because it's being infected by people's political biases. The way the survey is conducted, they do ask a subset of the respondents, they get a lot of demographic information, including what's your party affiliation? Are you a Republican? Are you a Democrat? Or are you independent? As soon as you ask somebody that question, game over, you're done. Because every other thing they respond to, they will respond to through the prism of their own political thinking. And you can see it in the data. If you go look at the University of Michigan survey for Republicans, the day after President Trump was elected, confidence went from being the worst it's ever been, even worse than it was in the teeth of the pandemic, to not so bad, not so bad. Democrats went from, oh, this is an okay economy, to this is an abjectly washout for the economy. So our political views are really critical to how we think about things, particularly in the context of the world we live in, social media, and the political fracturing that's gone on in our society. It's making it very increasingly difficult to use surveys to try to understand what's really going on in the economy. Now, I like the Conference Board survey. It doesn't have the same kind of bias, and it does a much better job of being consistent with what consumers are actually doing. So I trust this. I still value this series and data. That's why I'm showing it to you. And if I had to pick one series to look at to gauge, what whether we're going into recession or not, this would be the one. So if next month the Conference Board survey falls another 5, 10 points, brace for impact. Brace for impact. Maybe that's what I should have called the talk. Brace for impact. Brace for impact. Okay, so the third point is the data itself is increasingly more difficult to use, and not only because of the effects of political affiliation infecting the way people are thinking about their own financial situation and how they're viewing the world and their behavior, but response rates are down, quite considerably, and you probably know this better than I. But this gives you a sense of how rapid the erosion in response rates to surveys have been. This is the response rate to the CES, the Current Employment Survey. That's the basis for that's the establishment survey, the basis for that payroll employment number that Ahu and I were trying to predict every month. The CPI, Consumer Price Index, ECI, the Employment Cost Index, that's the best measure of wage and compensation in the economy. It's a quarterly series, controls for the mix of occupations and industries, which can affect your view of wage growth. JOLTS, a job opening labor turnover survey, that's really critical in the current environment. One other thing to note is one reason why the economy is hanging together, maybe the key reason it's hanging together, is businesses are very reluctant to lay off workers. A lot of debate as to what's going on, labor hoarding, it's unclear. But if they start to lay off, we got a real problem because they're not hiring. Hiring rates are very, very low by historical standards, to historical norms. So it feels like the labor market is actually much more tenuous than you might think by looking at the 4% unemployment rate, the 4.1%. But that data comes from the JOLTS. CPS, Current Population Survey, that's the household data, the unemployment rate. Go back, I'm showing you data in 2015, then around just before the pandemic and in the pandemic, just to give you context. And then 2024 is the last data point that I have. Take a look at the CES, that's the blue line. If you go back 10 years ago in 2015, it was a response rate of 60%. You can see now we're down to just over 40%. Take a look at the JOLTS. That's even more incredible. We were at a 2/3 response rate, back 2015. We're down to a 1/3. And look at the trend lines. The trend lines here are pretty scary. And this goes to, if we're going to fix this, we need this data. Without it, we're flying blind. We don't know what's going on. To fix it, we need better surveys. To get better surveys, you need better funding. But go figure. We're doing just the opposite of that. The other thing I worry about, and I'll end here, is the politicization of our economic data. The trust that we have in that data, that's critical to making good policy decisions. If you don't trust the data, you can't make good policy. And I do worry that, in this world that is dead ahead, where the economic outlook is going to turn darker and recession risks are going to continue to rise, that there's going to be aspersions thrown at the data and undermine the trust in that data, and that's just the timing of that couldn't be worse. So, brace for impact. Brace for impact. Now, I should end on a positive note, and there are things to be positive about, and I am going to end with this. Those other periods of uncertainty, those were pretty bad periods. 9/11 was pretty scary. The global financial crisis, I can attest, was very scary. Being, on the front lines on Wall Street. And it was very scary. The financial system needed to bail out. If it didn't get it, it would have been a wipeout and taken everybody with it. The pandemic was very scary, at points in time. So we've been through scary times, and we've navigated through. When economists forecast the future, they look at history. And our history is a positive history. We have always overcome. We've always done the right thing. We've always prevailed. And I see no reason why that can't be the case today. But we need good institutions like the Coleridge Initiative to be able to do that. Thank you very much. Thank you very much.